what we see in the ongoing bull trend in the monetary metals and their miners is a pause. And it's very brief so far. We're talking like 3.5, approaching 4 months here if we get into the first week of next month. But largely, the break occurred on January 31st and February the 3rd. Last day of January, first day of February. If you look at your charts of gold and silver, you'll see whoosh, all of a sudden, a matter of hours, literally, it happened. Okay. And then since then, you can draw a line sideways, up and down. And fortunately, we had, and we applauded this when it happened, and we kind of expected it. There was a low in February. God, we can't take out that low. We'll go down to $20 silver, whatever, whoever you want to say, and get gold go back into 3,000. Well, we went down on March the 23rd in both metals and swept the February price low, meaning everybody who had a sell stop there, and no doubt there were a lot of them, got stopped out. Great. You know how long silver stayed down there after breaking that major low? 2 hours. 2 hours, and it went vertical after that. Gold took a day or two, okay? But basically, when you swept that major, quote, low, nothing happened except buyers came in. So if there was an opportunity to get a real top or a deeper correction, that was it. And it got blown. It didn't work, okay? And now we're where? Right about in the smack in the middle of that up-down stuff. Now, if you look at a price chart of silver and gold, you say, well, I'll be a believer if it goes back and makes a new high, okay, like 120 plus silver and gold 5,600. But if you look more closely at the price action, especially on silver, you'll notice that all the rallies since that January, February collapse peaked just above 90. There's like 4 different rallies that probed up there, and there were sellers. Now, they've been selling 4 times, and that 4th time was like a couple weeks ago. We traded 90 also. But they can't seem to get the downside going. All they can do is get a pullback. So it's 4 times. So if I were just looking at a price chart and forget that nearly phantom $120 high, because that only lasted for like hours or a few days. Okay. So it really wasn't like you lived up there for any. But you look at 90 and you can see this repeated selling there. And therefore, if I were a simple price chartist, I would say, gee, get back over 90 again by any, couple bucks or so. I'm a believer. We're going up. Okay. Now, what we're doing at MSA is we're trying to identify via intermediate momentum trend technicals. Why not long-term? Because long-term is still positive. It never went negative. It can't say buy me again because it hadn't said sell me. Okay. But the intermediate stuff did. It broke down in that Jan-Feb break and has been healing since then. Much like the price has been going sideways, the momentum has been building structures overhead. And they're much closer than silver getting back to 90, by the way. Okay. And gold has some key numbers, and the miners each have some key numbers. And we put them in our report, and they can adjust weekly and sometimes daily. And so there's levels not too far above where you're trading now in both metals that say, oh, this rally is going to take hold. We're going up out of this congestion zone. And that's what we're focused on. And I think once that occurs, what's on the other side of this violent pause will be upside move that is far more dynamic and vertical than what preceded it. Silver went from last November was in the mid 50s. It had just taken out the all-time $50 high. Within a couple of months, it was 120. People were awed by that. I wasn't. I think it's going a lot higher. There's so many factors that argue, both fundamental monetary measurements, silver versus gold measurements, net trend of silver dynamics, and what's happened in a couple other major markets over the decades, similar to what's going on with silver, argue for a new reality and very suddenly. And I keep coming up with a range between 300 to 500 as a reasonable zone to reach, and likely to reach it within, let's say, 3 months of having cleared this congestion zone. In other words, boom, it's over. And no doubt the doubting public and others will suddenly gush in to want to join the game late in the game. That's fine. They provide the fuel, okay, the verticality. And, I expect that. Anyway, that's what I think is going to happen. And I'd have no reason to change that assessment. That silver's headed for a new reality and likely will achieve it by late summer. A lot of people like to think of silver as an industrial metal. And if you go back and study, for example, the Bloomberg Commodity Index going back decades, and look at copper, for example, or oil or any of these things, they tend to move in large waves with, not necessarily month to month, but big move to big move, with the Bloomberg. In other words, they move like a commodity. Silver doesn't. Silver moves with gold. And there are plenty of times, so for example, gold made a bear low in 2015. It went up and doubled by 2020. It went from 1,050 to over 2,000. Okay. And then went sideways for a couple of years. But it doubled in price during that same late 2015 to mid 2020. The Bloomberg went down. the whole time. Commodities went down, gold was going up, silver went up with gold. Okay. So I expect them to trend together, but I do expect gold to create something dramatic, but it won't be percent-wise anything like what I expect out of silver in terms of relative performance. So yeah, watch gold. It's a good place to be, but silver during this move to a new reality is a better place to be by far. And so are silver miners versus the gold miner. And when you plot charts, spread charts, relative performance between silver and gold, you could see that back last November, we took out a 10-year range high at very low relative levels, silver to gold, like 1.5% area, or closer to 1%. Heck, in 1980, it was 6.5% the price of gold. In 2011, it was 3.1. And right now, we're still under 2%. So if silver even just regained some of those old highs on the relative performance, it's already taken out those price highs. So why doesn't maybe the relative performance is going to catch up as well? Then silver will double, triple, or whatever versus gold. And the same with the silver miners versus gold miners. If you plot them as a spread chart, you can see they broke out several months ago. And sure enough, since then, silver miners have actually month to month been beating the gold miners. Nobody notices that, but it's a measurable event. And I think that's where you want to be in the monetary metals. Where could gold go? I don't know. All I can say is twice before, since legalizing, it had two eightfold moves, different time spans, but both were eightfold dimension gains from bear low to bull high. I've said this before to you on your show. And if we have another eightfold move, it will be $8,500 because our last low was $1,050. Now, even J.P. Morgan came out with a report several months ago, fundamentally based, no doubt, that argued for $9,200 gold as a working target. I don't think it's a target. I think it's merely, I did it again. I've had another eightfold move. Well, that's nothing extraordinary. It's done it twice before, eightfold gain. This time we have fundamentals that are far more dynamic and nuclear than any ones we've ever had before. We have a government bond crisis, like Jamie Dimon told us 2 weeks ago. You got a government bond crisis now, and we're going to have to deal with it. And he didn't mean 10 years from now. He meant it's coming. It's now. We can't keep pushing it off. So that's an event that the public and financial TV really hasn't put up front as a major issue. I don't know why. That's fine. They'll figure it out later. You don't need new debasement, although there will be, because we know the government bond markets now are in trouble.
Yes.
In 2007 through 9, we didn't have a government bond crisis. We had a mortgage crisis. In 2000 to 2002, we didn't have a bond crisis. We had a dot-com bubble. Okay. This time, we have the alternative asset that everybody sees as the 60-40 rule, 60% stocks, 40 bonds, is no longer balancing your portfolio. Okay. And it's puking. Okay. And the Fed knows this. In fact, they effectively stated such back in November when Williams, head of the New York Fed, said we're going to start buying bonds. Oh, not to save the market, but to provide liquidity. Okay, nice, subtle excuse. It hasn't helped. Bonds gone down anyway, yields gone up. Okay. And right now, the long-term bonds, talking 30-year, are toying with yields they haven't seen in 27 years worth of yields or so. Okay. And same with the price charts. They're laying on the floor. Ugh, can't seem to get off of it. And we're literally, one bad week away from making all-time new lows. Not all-time, but multi-decade lows in bonds, multi-decade highs in yields. And the government doesn't control this end by simply lowering rates or anything like that, because that's the 90-day stuff, okay? So they're not in charge, but they know they need to be. And yet it's not even one of their mandates. Defending government bonds is not a third mandate, yet it is, believe me. And the Bank of Japan has shown that. They tend to be a leader in developing monetary excess. They came up with QEs and ahead of us. And anyway, they're in panic mode. Prime Minister there a year ago said, we're going to print. Wow, great. She's a free market advocate. Okay, that's cool. And now we're going to have a new Fed chair, who's no doubt going to be easier than Powell. But really, that's not the issue, because the Fed doesn't control things. It tries to, but it really doesn't, because if it did, then there wouldn't have been stock market bear in 2000, 2002. They cut rates all the way down. Didn't help at all. 2007 to 9, they cut rates even at the top. They printed the top tick in October 2007 when they cut rates in mid-September. And yet the market went down and collapsed, cutting rates all the way down. So they're not really in charge of JS, okay? And so no matter who's in charge, it doesn't matter. And it doesn't matter whether, quote, inflation is high. Because really inflation is what? You know what it is. It's a money growth, M2 chart. And that chart is an upward curving arc. So that's the reality silver's catching up to. If you measure an ounce of silver in 1980 versus the quantity of M2, whoa, and put it even with the money growth since then, you're talking $500 or so. And you go back to 2011 when silver was $50, catch up with money growth since 2011, you'd be up at 300 or so. So there's all kinds of reasons to come up with that zone, and there's others as well. I think fear drives more than greed almost in this case, where you look at a couple of examples going back 50 years or so in gold, where you see a period of time where rates went up a bit and gold went down, et cetera. But when you look at, I don't know what these people are looking at really. They go back to the late 70s when we had global recession. They call it global stagflation because prices went up. The Fed drove rates off the page. Short-term rates and long-term bond rates, like 30-year bonds, went from a yield of 7.5% to 12.5%. Okay, right now we're around 5%. Okay, so 7.5% to 12.5% vertical. Not just the Fed on the short end, but the long bond. Rise in rates. Gold exploded all during that time. It replicated the rise in yields. Wasn't hurt by it. Okay. And this has happened before. There's other times when gold's had a big move and yields have gone up and it hasn't mattered. That was a particularly strong evidence. But there's too many times that's not the case. Meaning, I bet I could do a moon phase analysis and come up with a better correlation for gold than whether the rates are going higher or not. Okay. And then with the stock market, it's the same story. Yes, there are times where during an ongoing bull market like 2001 to 2011 in gold went up eightfold. In the middle of that move, in 2008, the stock market had been going down for an entire year from 2007 to 8. Gold wasn't going down. Then in September, October particularly of 2008, the stock market, a year off its high and way off its price high, had what you could call a collapse month, more than 30% in 1 month, in weeks, in other words. Gold participated. In other words, it took a break in its major uptrend. It had a huge down month in sync with the stock market. At that point, Bernanke came in with a page out of the Japanese book and instituted QEs in November of 2008, a year and a month off the bull high. He'd been cutting rates all the way down. It didn't work. He did QE. And if you look at what happened to stocks starting in November 2008, they collapsed through March 2009. QE didn't stop the decline. Almost 2 more quarters of decline. Gold